So, Kevin, welcome to the big conversation. Thank you for joining me.
Hi, James. Thanks for having me.
Good stuff. So, look, what we want to focus on today is the nature of the Fed, and it's what will the Fed do versus what the Fed perhaps ought to do. And things have got a lot more fluid, I think, in recent weeks. So, I'd love to get your thoughts on what's going on there.
I guess what the Fed will do and what they ought to do, hopefully in the medium term, do coincide. But then the interesting thing for market participants and investors is thinking about when will the sort of what they should do, when will that get pulled from what they say they're going to do, what they think that they might do. I think an interesting thing to think about is how we got to where we are currently. So the Fed for a long time was saying it wasn't going to raise rates. Investors mostly were buying that story. Throughout most of the pandemic, Fathom was warning basically that this was going to be in the end an inflationary shock. And so for us, we're saying what they ought to do was think about raising rates, much more than what was being priced in and certainly more than what they were guiding towards. Eventually, that's what happened. But interestingly, at this current juncture in our most recent summer global outlook, we're now below where market pricing is in terms of what the Fed will do. That's for both this year and for next year, and that's certainly below what the Fed themselves say they're going to do, or what the FOMC says it will do in terms of market pricing. So in our view, I think what they ought to do is probably not increase interest rates as much as they're guiding towards. The principal reason for us in terms of thinking about this is that we're far more concerned about the risk of recession. If you think about what they expect in terms of inflation and what they expect in terms of unemployment, for us, probably what they expect in terms of inflation is broadly going to play out. And so we see a lot of the risks relative to their own forecasts being on the demand side. And since they have a dual mandate, in our view, it makes sense for them to start worrying a lot more about growth and also about the outlook for the labor market.
That's an interesting one. So, in terms of data points, and you mentioned inflation there, there has, of course, been a series of more hawkish comments coming from the likes of Neil Kashkari and co. Since the July rate decision just a couple of weeks ago. In terms of the inputs or the data that they're looking at and are likely to shape their decision ahead of the September meeting, what exactly or what specifically do you feel is sort of contradicting where positioning and sentiment is currently?
I think in terms of the September meeting, probably I'd say, there's not a huge amount that can happen. We're not going to have a completely different view on the labor market by the time that meeting rolls around. I guess for me, it'll be thinking about how much emphasis are they putting on forward-looking indicators. So I'd say at the moment, jobless claims probably is one of the key things they're watching. We'll get payrolls. Payrolls are a bit lagging. Employment in general is relatively lagging, but I'd say wage growth within the payroll reports will be important for them to watch. But I think more broadly, looking at surveys and sort of more timely measures of spending, perhaps how, even things like how gas prices are playing out, as that might feed into inflation expectations. And Powell really emphasized that at the June meeting. So I'd say, a mix of different things, but I'd say for September, I'd say 50 basis points is probably quite likely. 50 basis points, maybe 25 basis points if we get a bunch of bad data. But I'd say looking forward, that's really where the big question marks lie. With markets pricing in sort of cuts next year, and the Fed, in their most recent projections at least, pricing in continued increases through 2023.
Yeah, and we certainly saw the market react, equity investors and also I think the 5-year portion of the bond market react to the perceived Fed pivot coming out of the July meeting. It may, according to what you've explained just there, and according to the Fed's comments themselves, seem a little premature. There are people equally in another camp that are perhaps or have been calling for a potential peak in inflation. Now, according to what you've just laid out there, until we see a correction in gas prices, amongst other things, it seems as though inflation is likely to remain elevated. And you see the terminal rate roughly in line with what the Fed is aiming for. One of the things that stood out to me, I don't know if you caught this the other day, but the ISM manufacturing survey The PMI didn't come in perhaps as low as people were expecting, and indeed equities were implying in terms of the pricing. I think they were implying a drop to probably 40, well, below 45, depending on which basket you were looking at. One of the things that stood out to me there was the prices sub-index fell off a cliff. It dropped 18.5 points. Now that as a potential lead indicator of inflation, whilst one swallow doesn't make a summer, and there are a bunch of other indicators out there suggesting that inflation is looking pretty persistent for now. That's one of the things that stood out to me. Do you have any thoughts generally about the ISM in terms of the level it came out at versus expectations, but also what's happening beneath the surface?
I think, yeah, certainly the scale of the drop was a surprise, but I think the broad picture of goods disinflation, if not quite deflation yet, that's a story we've been expecting to play out through the year, and a lot of other analysts have been expecting that too. I think you're starting to see more and more signs of this, and so that's really, I think, something that will give the Fed some comfort is if you look at shippings prices, if you just look at even used cars prices, I think you can expect them to start to fall off now a little bit. Commodities prices too, even after what's going on with Russia and Ukraine and with oil prices and copper prices getting really high, those have started to roll off too. So I think in terms of goods, in terms of a very weak global backdrop, all of that is really going to help at least headline inflation. FOMC has put a lot of emphasis on this. I mean, my way of thinking is they should really be looking at core inflation because that's what the domestic U.S. economy is delivering. But any kind of easing in headline inflation will be beneficial, particularly as the key risk has been that inflation expectations will slip their anchor. If something like that were to happen, then they'd be forced into a much more aggressive hiking. The key question, though, as you say, is that price pressures have been broadening, and you do see that across services. A lot of that is related to domestic demand. Some of that, things like rent, those are very slow moving forces. And so I do think it'll be a mistake for the Fed to wait for all of those things to turn a corner before responding. If they do that, they risk making a similar mistake, but in the opposite direction of waiting for inflation in the data to move a certain way before adjusting. That's what they did, and they probably hiked rates a little bit later than they should have around a year ago. And if they make the same mistake now, they may end up sort of either pausing or even reducing rates too late than what they should do.
So I guess in short then, to conclude, we opened with the question around, are the Fed doing what they ought to do and what people are expecting? I think in short, it seems as though, okay, you see the potential for a slowdown, or you do see signs of slowing in the economic outlook. Inflation may well remain persistent for some time, though it's important to look at, of course, the leading indicators of that, as well as the business cycle in general. But it seems as though the Fed probably are doing, in your view, what they ought to do.
I'd say for now, just about, although it is hard to judge that for sure. We had a different piece, which was essentially saying the Fed and other central banks are faking it until they make it. So to some extent, they do have to bluff, primarily to keep inflation expectations on their side. And so some of this rhetoric that we've seen recently about, we're not even close to being done yet, I think some of that is really just to put some pressure on the markets to make sure that financial conditions don't loosen too much, because they are worried that then could lead to future inflation problems. If that's all it is, then yes, I'd say they're doing the right thing. But if they actually genuinely believe that, I think then there is a high risk that they could end up making a policy mistake by basically going too high, and then they'll be forced to cut quite aggressively if they do make that mistake.
Interesting. And that does seem to be what the market is pricing in terms of next cut. So that makes a lot of sense. Maybe then the July rally could perhaps be an opportunity for the Fed to press ahead, but whether or not ultimately they end up overloading or front loading their rate hikes too heavily remains to be seen. So Kevin, thank you for joining me. That's been a fascinating conversation, and look forward to speaking to you again soon.
All the best, James.